What's up, guys? Welcome to the multidimensional trading video series. This is video number 5 or part 5. And what we're going to get into today on this lesson is the liquidity grab. Okay, liquidity grab is something that you can see on every time frame from the 1 minute to the daily, the 1 hour, the 4 hour, whichever time frame, the 15 minute, the 5 minute, whichever time frame you like to trade, you will find this setup on multiple time frames. And when you do, you know you have the clean, clear direction for a while, at least until you run into resistance like it did here on the 1 minute on the E-mini NASDAQ, on the micro E-mini NASDAQ, right? We had a nice snatch right below these lows and a quick rejection. That's the liquidity grab. That's how it looks. That is the objective physicality that you want to see to know what just happened. You know that liquidity has been grabbed and it rejected real hard. When you see that, that's when you know, okay, we snatched below these lows, we rejected real hard, and we closed, the candle closed above the line, okay, and then took off. Where will we get out? Obviously, right into the 369-day EMA. That's where we'll find a roof. That's where we'll find a ceiling. That's where we'll find resistance. The liquidity grab looks like this on every chart, on every time frame. It's the same. It looks the same, right? What you're gonna see is some equal lows or a low or a low. It could be a single low, and then you're gonna get a flash spike right below it, and then a rejection, a quick rejection. That is when you know, okay, that was the liquidity grab. Because the break and retest, like we talked about in the previous video in part 4, price would have broke strongly this way with volume and then retraced back to that level and then continued down. That would have been a break and retest of the level, and then we would have got in short, right, and then went down. That's not what happened here. What we got was a spike and then a clean rejection. No break of the level. It looked like it was going to break, but it didn't. Clean rejection right at the level. See how the trend line is right at these lows, because we gotta be objective. We have to have that trend line in the objective place right at the lows, so we can see it visually what just happened as clean as possible. Okay, if we didn't get that that break and retest, we're doing something totally different. We just witnessed a liquidity grab. We got a spike below the lows and then a clean rejection right after that, almost immediately, right? The next candle. And then what follows? The uptrend, the reversal. Okay, what we're doing is catching the reversal and we're riding it up into resistance until we find an objective resistance again, which so happened to be on this time frame in this chart, the 369-day EMA. Okay, very clean rejection, very clean. Okay, so we can do the liquidity grab from the highs as well. You would see it right here. Okay, I'll take this level off so we can just mark it out with our one trend line. Okay, same exact concept, right? Liquidity grab. Okay, that way you guys can see it. There's a high. Okay, we looked like we were going to poke through that high. Sharp rejection. Sharp rejection. Down we go. Down we go. Okay. Very nice. Okay. We also would have took profit here, right into that 369-day EMA. Okay. And then if we seen the liquidity grab, then we could probably even switch and take the short position. Okay, that's extra points with a cherry on top, right? You caught the long liquidity grab. You took your profit. You've seen how it reacted here. It rejected at the high, and then you took a short. That is very possible. As long as you understand and recognize exactly what you're seeing, that's all that matters. You can take advantage of it both ways. Okay? It's very easy to see. This happens on every time frame. You can do this on the 1 minute to the 1 day. Okay? All the way up to the 1 day, the 4 hour, the 30 minute, the 15 minute. You're going to see the same exact setup. You're going to get a snatch below the lows and a clean rejection from those highs. Once you get that rejection, you have the opportunity to take it the other way. Simple as that. Obviously, the larger the time frame, the more the more profit, or the longer you have to sit into that trade, the longer you can swing that trade, the larger the time frame, right? The more time you have to let that trade run. Okay, we'll go to Bitcoin, and we'll go all the way to the 1 day chart. That's the XC version. Let's go to the actual crypto version. Okay. So same exact concept. Liquidity grab, right? This is the live Bitcoin chart. This is what has happened recently, right? We had a spike up right above the high and a super hard rejection. I'll take you guys down to the 12 hours so you can see it nice and clean here. I'm sorry, I went 12 minute, 12 hour, okay. That way you can see exactly and visualize it exactly how I'm saying it, exactly what happened to the chart. Right? We had this high right here, a fat spike up. This was Trump's before the inauguration. Fat spike up right above the high, and then the next 12-hour candle, a fat clean rejection, right? And that spelled the down trend. It said, okay, well now we're going down, right? Because liquidity has been grabbed here. It's not going up. We didn't do the break and retest, right? We didn't do that where we continue up here and then come back down towards this level and then continue this way. We didn't have a sustained run above and then come back down to retest the level. We didn't get that this time. We got a spike right above the high and then an immediate rejection. That's the liquidity grab. That's the objective thing that you're looking for, to know that the trend has changed and is not about to continue. That's when you robotically just take the other side of the market. Okay, it is as simple as that. That is the liquidity grab in a nutshell. That is it. You can also see it here from the bottom without me even really pointing it out. You guys can see how these are lows. These are low points of the chart. We ran right below them and rejected immediately. And then that was our run back up to, or all the way to, a new high, an all-time high, which is 109, right? Went from 89 to 109. That's crazy. That's a 20 grand run from this liquidity grab, right? And I mean, you can see it nice and clean on the chart. Using the trend lines give us visual aids to really see exactly where we're at, right? We have a break of these lows and an immediate rejection. And remember, it closed above, closed up here actually, right? Immediate rejection. Look at this. It broke above, it closed below that high, and then an immediate rejection. Okay, stab below these lows, and then violently went the other way and then closed above this level, and then we get that continuation up. Okay, that's a liquidity grab. Okay, it's basically what you would hear other traders refer to as a fake out, right? The liquidity grab is a name or a term that I first learned from ICT. Great trader, great teacher. Still see him on YouTube from time to time. The liquidity grab is a term that I learned from ICT, and perfecting it and practicing with it and paper trading with it and live trading with it is how you see it happen over and over, to where you understand exactly what you're looking at. It's not a mystery as to what just happened. You see it consistently, repetitively, right? It's how the market operates. If everyone thought they were going to go short and they were going to have this breakout, they all probably put on contracts, or not everyone, but say the 80% of people who are not aware of these setups put on contracts. And then if they all go short, to get out of their shorts when it starts to run the other way, they all have to start buying. Remember, because if you sold a contract, the only way to get out of that contract is to buy. Okay, so if it spikes below here and I took a short at the last minute and it runs back up on me, the only way I can get out is I have to buy my contracts back. And then if everyone, or the majority of people who went short, the majority of the market, the 80% of that market that went short, has to turn into buyers, there we go. We get all of this buying pressure. Okay? Gives it that fat run. And then the other people who, just like ourselves, just smart traders, we're getting in and buying right along with them because we understand what's happening. We understand what they must do, right? Markets move because they have to, not because they want to, right? Because they have to, right? So if it runs this way and we all get happy-go-lucky to go short, or a majority of people get happy-go-lucky to go short, to get out of their positions, they have to buy it back. Simple as that. And that drives the market up. That means the market has chosen to go up because it has to at that point. They have to become buyers. They were sellers down here. It didn't do what they believed it to do, and they have to become buyers. As simple as that. And that's when you get the liquidity grab. It's what it was termed, right? But this is a physical structure. Right? You can call it the fake out, the liquidity grab, but you understand what you're looking at when you see it. Okay? And then the psychology on the other side of the coin, which is the top side, right? The short side. Okay? Same concept. If I thought it was going to break out here, I'm buying, right? I'm trying to buy for a continuation. The only way for me to get out of my buying is to take the opposite side. Well, so I have to sell. So all these people who, maybe the 80% of the market who thought we were going to have a continuation and have a super rally into Trump's inauguration on the 19th, they all became buyers here. They all were trying to buy and think we're going to new highs, which we did go to a new high, but they were buying for a continuation. Right? The only way for them to get out of that trade is to become sellers. Their stop losses, their sell orders, if they hit close their position, those are also sell orders. So what are we going to do once we see that rejection and that close below? We're going to sell right along with them because we understand the psychology of the market. They have to become sellers at that point. So we will become sellers at that point and sell contracts and write it down. It's as simple as that. Alright guys, this has been video number 5, part 5. Practice, paper trade, do it repetitively, over and over, right? Use TradingView, use your trend lines. It doesn't take much tools to actually use to understand what you're looking at, right? That's it. Remember, nothing in these videos are financial advice. I am not a registered financial advisor. These are only for educational purposes only. Use them, practice with them, and yeah, do it continuously, do it repetitively. Okay, you will see progress over time. Remember, like, subscribe. I will see you guys in the next video, video number 6, part 6 of the multidimensional trading video series, coming soon. All right, that's all I got. Peace.